Hi there, welcome to The Close. I'm Andrew Bell in for Mirella Fernandez today. Markets closing in just half an hour and investors shaken once again by a new surge in oil prices. The cost of crude once again hitting the highest since 2022 when Russia attacked Ukraine. Let's get to the big stories we're bringing you from our newsroom. So there is a look at oil jumping more than 11%. And that WTI price is actually at a steep discount to actual physical near delivery prices that are pertaining around the world right now. So there's a new surge. US President Donald Trump said strikes on Iran will continue. In a primetime address last night, Trump said US forces have significantly weakened Iran, calling the military campaign unstoppable. He added that operations will continue until objectives are fully met. He also threatened once again to strike Iran's electricity generating plants. Deloitte is cutting its forecast for Canada's growth. The firm slashed its growth outlook for the economy by 20%, and it predicts real GDP is set to expand just 1.2% this year. Deloitte says soaring energy prices linked to the conflict in the Middle East will weigh on consumer spending and also hurt businesses and will further impact economic challenges and uncertainties ranging from foreign trade to a soft labor market. Industry Minister Melanie Joly says China can't just bring cars in a kit to Canada to be assembled. Speaking in Vancouver, Joly said the workers involved and Ontario must support any plan by Stellantis to build Chinese vehicles. That comes after a report that Stellantis is exploring plans to build electric vehicles with Chinese partner Leap Motor at its idle plant in Brampton, Ontario. Ontario Premier Doug Ford says any deal to build EVs in the province would have to use local parts, adding that anything else would undermine Canadian auto workers. Shares in BCE, Rogers and TELUS have been seeing some selling today after a downgrade by TD Cowen. Analyst Vince Valentini said recent strength in the stocks has been due to investors seeking safety from geopolitical uncertainties. He adds that aggressively low pricing seen late in the quarter is not fueling volume growth, but rather churn and negative repricing. A reminder that BCE is the parent company of BNN Bloomberg through its Bell Media division. And we are getting an update on the tariffs on metals imposed by Washington. President Trump has signed a proclamation on metals tariffs, clarifying the structure. The U.S. companies have been complaining. We don't know exactly what we should be paying because these duties apply to goods that include metal. So the U.S. is imposing 25% tariffs on steel, aluminum, and copper derivatives. The metal derivatives tariff applies if the item is at least 15% metal. They're also pushing ahead with plans to put tariffs on drugs, although there are a whole bunch of exemptions. It's 100% tariff on patented drugs, but Japan, the Swiss, the EU, South Koreans, and the Brits are exempt. But they're trying to bring more drug production back into the U.S. Let's have a look at how the markets fared today. The TSX hanging in today. Obviously, investors in energy stocks encouraged by this latest surge in energy. One crucial global contract, dated Brent, has gone to its highest since 2008. So there's widespread worry around the world just about the availability of energy, and that's pushing up the price dramatically. The Canadian energy producers were up about 2% today. And let's have a look at the U.S. markets. As you might expect, they did come under some pressure, although pretty modest decline, with this increase in energy threatening more inflation. But here's another economic theme. The trade deficit in Canada widened to $5.7 billion in February. This is the largest shortfall since August. Now, the data, of course, reflects activity before the war in Iran. Economists, however, say the impact of higher global oil prices and that pullback in gold is likely to show up in the March report. We are joined by Shelley Kaushik, senior economist at BMO Capital Markets. Kelly, thank you very much indeed for joining us.
Sure, thanks for having me, Andrew.
What jumped out for you with this trade deficit report?
There's quite a lot of volatility in there. I mean, as you mentioned, this is even before the war, and we know the war is going to add a whole lot more noise to the data. But even before that, we saw quite a bit of volatility. You mentioned gold prices, and also gold imports and exports adding quite a bit of noise in January. But also there was a bit of a recovery in auto production in the month. We did see auto production kind of taking a bit of a longer than normal break in January due to some retooling and model changes. And so there was a very big snapback, a very significant snapback in autos, showing up as strength in February, but of course it's strength from a weaker number in January. So there's quite a lot there, but I think the main takeaway for me was, despite all of the noise from those kind of one-time factors, it was still pretty broad-based strength for both imports and exports, and I do think that that's pretty positive for overall economic activity.
Should we worry, though, about this big trade shortfall?
Yes and no. So yes, it is the deepest shortfall that we have seen in a few months, but it's certainly historically not particularly worrisome. And of course, we know that energy prices are going to spike in the March data. So that will support Canadian energy exports, which will support the trade balance and hopefully help narrow that gap a little bit. But also, aside from prices, we know, of course, that there are these concerns globally for the availability of energy, as you mentioned earlier, due to the war. And so there is going to be just more demand out there for Canadian energy. And by that, I don't just mean oil. I mean things like natural gas. We're talking fertilizers. We're talking aluminum. These are all products that are facing these shortages due to the war. And there are also products that Canada exports or is a significant exporter of. So the balance does stand to improve as long as the war goes on. That's at least one silver lining for that source of uncertainty.
Now, I know it's just 1 month's numbers, but apparently our trade surplus with the U.S. narrowed to less than $2 billion. And this is apparently the smallest surplus with the Americans since 2020.
Yeah, it's certainly very volatile numbers, even in the best of times, let alone now. But I mean, it is clear that that the trade war is having some impact on the Canadian trade figures. Now, it is the smallest surplus since 2020, but of course, historically, that's not a very large timeline. It's only the smallest in 6 years. When you take a step back, yes, we have seen some efforts of diversification maybe showing up in the data. So, for example, the share of Canadian exports going to the United States has fallen to about 2/3 of exports going to that country versus roughly 3/4 before the trade war started. So there is a little bit of data, or sorry, a little bit of indication there that Canada could be moving a little bit away from the United States. But again, there's so much else going on in there.
Yes.
There's, of course, higher energy prices in 2022, let alone now. Higher gold prices also kind of distorting the picture there a little bit.
That's interesting. Just to give us that number, the broad trend is that we used to send 3/4 of our exports to the States, and it's now dropped to about 2/3.
Exactly. Yeah. So we'll see, how long that lasts, if it goes even further down. But of course, we know that that's kind of the direction that policymakers want to see Canada go.
Ultimately, maybe you could put up a 5-year chart for the Canadian dollar. Ultimately, if a country runs big trade deficits, it's going to tend to weigh on its currency. Canadian dollar, pretty stable right now, 72 cents US roughly.
Yeah, I think that's reflecting kind of these broader macroeconomic pictures. Of course, there's still some support from higher oil prices, certainly a much weaker relationship than we had seen in the past, but there's still some support there. There's also, of course, interest rate differentials. We know
Hmm.
that interest rates are much lower in Canada than they are in the United States, for example. And of course, this broader uncertainty, whether it's from the trade relationship, which of course does impact Canada,
Hmm.
but of course, the broader geopolitical landscape as well is kind of helping support the US dollar, especially over the last few weeks.
Thank you very much, Shelley. Really appreciate it. Shelley Kaushik, senior economist at BMO Capital Markets. Up next, U.S. stocks under pressure today after President Trump failed to reassure markets that an end to the fighting with Iran is in sight. We'll have more after the break. Investors are worried about inflation or even shortages of materials with this blockage of the Strait of Hormuz. There is a look at the S&P 500. It briefly managed to get into positive territory today, but was under pressure for most of the session. Our guest has some stock ideas for you in the energy sector. Let's get now to Hatem Diab, managing partner at Gerber Kawasaki Wealth and Investment Management. Thank you very much indeed for joining us, Hatem. So Trump apparently not reassuring investors, but stocks generally ending pretty flat, ending the week pretty flat.
Hey, Andrew, thank you for having me on. Yeah, there's a lot of anxiety happening. I think yesterday with his speech, everyone was expecting to get some nuance on when this war is going to end and how is that going to look for the energy markets. And unfortunately, we didn't get that. It feels that the administration doesn't have a real strategy. If I'm being honest, it feels like Trump is negotiating against himself and changing his mind every other day. So as a result, investors and markets are very jittery, very, very anxious. Also knowing that ultimately this conflict has to end. Trump does not want this conflict to go into the midterms. And as a result, I think if that happens, markets will recover nicely. But the longer this continues, the longer we have oil prices at this level, the more problematic it's going to be for the economy, for earnings, for margins, and frankly, for everything. Oil is an input in pretty much everything: food, anything that we consume, really, transportation. So that's kind of where we are.
Tell us about Tesla's numbers. You do see reasons for concern with their sales. Tell us about that, please.
Well, sales were down year over year, which kind of we knew that. Like the Tesla's core business is in decline, right? The brand name is damaged. But I think what's unique to me is that their inventory numbers were up by 50,000 cars this quarter, meaning that they manufactured 50,000 cars more than delivered. That's not how usually Tesla has operated. They usually operated on manufacture as you order. And what that just shows me that really the demand picture is negative for electric cars, and that's for obvious reasons, right? Like in Europe things are not as good, but the reality is the core business is down. So if you are investing in Tesla today, you're investing for the AI picture, you're investing for Optimus, FSD, which I'm actually very optimistic about. FSD is just going to take some time for things to work out.
There's lots of speculation about how much SpaceX will raise, but Bloomberg is reporting that right now the company is boosting its target valuation in the initial public offering above $2 trillion US. So it keeps climbing. Talk to us first about that. I know some observers say Starlink is the real value here in SpaceX.
Starlink is fantastic business, right? Like I think the TAM for that business is massive. But I think $2 trillion valuation for SpaceX, which basically does $20 billion in revenue a year, is an astronomical valuation. And I think what Elon is doing, Elon creates a lot of value in many ways. But I think what they're doing here is they're creating so much hype about SpaceX, and they're also only releasing about $75 billion in shares. So I think what they're going to do is they're going to create more demand by only releasing a small amount of shares compared to the valuation. But ultimately, I don't know how they can sustain that $2 trillion valuation going into the next year or so, once you can actually get to see under the hood, look at the financials, look at the growth numbers. But it's definitely one of the most fascinating IPOs that we will see in a long time.
Remember that from the .com days. Go thin to win. Just put out a few shares. What will that mean, though, I wonder, for Tesla stock? Will SpaceX steal some of the glory from Tesla?
Absolutely. I think, there's only so many dollars that can go into these high growth names, and Tesla is not really growing, but I think people would be definitely more excited to own a SpaceX, which is also another bet on Elon Musk, than they are going to own Tesla stock. So I think you're seeing that. And I think Elon is trying to allocate some shares to actually Tesla shareholders so they can avoid some of that capital flow from Tesla shareholders to SpaceX shareholders. But we are big Tesla shareholders here in the firm, but we're getting a lot of requests about inquiries about buying SpaceX and so forth. So we're seeing this firsthand, and I think that's going to be the case as the stock comes out.
You have a couple of energy-related ideas, not just simply oil and gas producers. GE Vernova, they make these gas turbines, and they are huge in the build-out of data centers, apparently.
Massive. I mean, I think if you think about AI in general, the biggest constraint is energy. And actually, our energy demand is going to increase about 3x what we currently have if you assume all the data center investments that have been announced, or at least have been planned for the next few years, right? So you have to understand, or have to own some of the players that are going to build this infrastructure. And GE Vernova is really one of the biggest one, because they build these massive turbines that are able to convert natural gas into energy. And they actually provide a full solution, from software to electrification of the grid, to like a really full way for the grid to be brought to the future and provide a lot of this energy need.
Thank you very much. Really appreciate it, Hatem. Hatem Diab of Gerber Kawasaki Wealth and Investment Management. Up next, more on this reported plan under which Stellantis would bring Chinese-made electric vehicles to Canada. Canada's EV market is set to shift gears after the Prime Minister announced a deal that would see China allowed to send in up to 50,000 or so electric vehicles with a modest tariff. However, questions have lingered over who would build these cars and the possibility that some of them could be made here in Canada. Bloomberg, in a report, suggests that Stellantis may be the first major automaker to step up. It reported that the company is in talks with China's Leap Motor to build EVs at its vacant Brampton plant. We're joined by Flavio Volpe, president of the Automotive Parts Manufacturers Association. Flavio, thanks for joining us. What are you hearing? Do you think Stellantis really is working on a plan like this?
Well, look, Stellantis has a 20% position in Leap Motor, and they've been partners for the last number of years, working jointly on the technology. Stellantis is under a lot of pressure, both from the union, Unifor, as well as the government, and as well as part suppliers, to come up with a plan for Brampton, which had idled, which, when it wasn't idled in 2024, made 150,000 cars, had $7.5 billion of industrial activity, bought $3 billion worth of Canadian parts, employed 12,000 people locally, said, come up with a plan. The report yesterday was that one of the options of the plan is work with Leap Motor to import knockdown kits that would have zero local content on them. It would have 300-400 jobs. And the only industrial activity, the only investment in that plant that was any Canadian content might have been, $20-25 million worth of wages for the year. And so we've been pushing back. Lana Payne and the union pushed back. And I saw the minister today say, well, we're not going to allow that. And I think that's really important. It's a devolution of the industry. It's not an incremental investment. It's saying bye-bye to billions of dollars of activity and tens of thousands of jobs.
You want to see a full regular plant that builds cars from the ground up?
Well, there is a full regular plant, and the company that owns it says, oh, well, wait, when we see that we get restored access to the U.S., I promised the CEO promised the Prime Minister that we would see a product there. They've got product that they need to assign, and that assembly plant has been assembling vehicles, not knockdown kits, since 1962. And there's no sense in taking a bad deal and locking in all of these losses. Better to wait the next few months to see if we regain that access, and then push the company to live to its obligations that it made to the union, and the tacit promises that it's made to the community, to the province, to suppliers that serve it in all other places. In fairness to the company, they didn't leak this news. I don't know who benefits from hearing one of these options, but it's important for all of us now to understand what a CKD is. CKD versus assembly is kind of like, think about IKEA. You and I could go buy a sofa and assemble it. It was manufactured somewhere else, came in a box. You and I are not manufacturing sofas. A CKD plant in Canada is not an assembly plant. It's not Canadian manufacturing. It's an import quota cheat, and we should call it out.
So CBU apparently stands for a completely built unit, and then CKD stands for completely knocked down, and that's more the IKEA approach.
Yeah, that's right. Yeah, CBU, or whatever plain English language you want to use, is, hey, if you're going to make a car, that means you're going to source the parts from local factories to meet the USMCA 75% compliance. You're going to buy steel from Dofasco or Algoma. You're going to buy aluminum from Quebec, and you're make a go of it like everybody else that's had to invest to make a go of it here, and that you're going to restore the employment of the people who work in that plant and the people who feed that plant. If you're doing CKD, which is these IKEA type arrangements, you are bypassing the import quota that has a cap. You can only import 49,000 vehicles by saying, oh, this is assembly. Well, you're just making the jigsaw puzzle there. You're putting it together and you're selling it like it's a picture that's on my wall. Anybody who does CKD here should have that count against the Chinese import quota, because that's all it is. And for one of the 5 companies that makes cars here to be allowed to devolve to a CKD is a terrible signal, but also a competitive threat to the other 4 who would be under the same pressure to do the same. Why would we do that?
We better leave it there, Flavio. Thank you very much indeed. Flavio Volpe of the Automotive Parts Manufacturers Association. Up next, those closing bells on Bay Street and Wall Street. And there we have it, the closing bell action. We are done with trading for the week because tomorrow is Good Friday. Brain Limited is ringing at the closing bell at the NASDAQ. At the NYSE, it's Michaela Schifrin, 3-time Olympic champion in alpine ski racing, ringing the closing bell. You are watching The Close on BNN Bloomberg. Let's see how the markets ended today. And look at that. We had a late rally in U.S. stocks. Hard to actually predict why. There are hopes, of course, that some kind of deal will be reached. Gasoline north of $4 a gallon in the United States. That is putting political pressure on the Republicans. It may well impel the White House, some observers think, to seek an end sooner rather than later to the current fighting in the Middle East. And that would reassure investors that this surge in energy prices, they can see an end in sight. But there's been such damage to the whole supply chain and to physical installations in the Gulf that this shortage of oil is likely to drag on for several weeks. But we did see that late rally in U.S. stocks. A couple of individual shares that we're interested in. Imperial Oil, the Exxon-controlled oil sands giant, that stock has been trading at new record highs. There's a look at it over the past year, up more than 70%. Let's have a look at Suncor maybe on the week, because Suncor came out. There's the 1 year up 64%. Not sure we can have a quick look at the 1 week for Suncor, because the company talked to investors. We had that interview with Rich Kruger, the CEO, and the company's saying it's on course to cut its break-even price for WTI to as low as $38 US within the next 3 years. So they are making plenty of money right now from their gigantic oil sands operations. There's Suncor on the week. Maybe you could have a look at XEG, because that's an ETF that tracks the Canadian oil and gas producers. You can see it's up less than Imperial Oil and Suncor over the past year, and it did increase today with that rise in oil prices. Rogers Communications did not have a great day, as we mentioned earlier. It's been downgraded by TD to hold, along with BCE and TELUS. And TD, the analyst there, Vince Valentini, warning of what he calls a price war risk. There's been very aggressive pricing, he said, observed late in the quarter, under $30 for big data wireless plans. But, and this does sound a bit ominous, it's not stimulating new consumers into the industry. People are just switching. And yeah, there was a turn up in pricing yesterday, but Valentini says, we believe enough damage has already been done to justify a more cautious stance. And there's Rogers. Do we have time to put up BCE? It was down a bit less. BCE, of course, the parent of BNN Bloomberg, down about 3% today. And TELUS was also off, the third big telecom that got downgraded. Of course, Videotron under Pierre Pelado, I should say Quebecor, is getting in the grill of its rivals with moves to expand market share. Okay, let's get more stocks on the move. We are joined by Bloomberg Equities reporter Stephanie Hughes. Stephanie, great to see you. Thanks. GoEasy is a relatively risky lender, and there are worries about its credit quality right now.
Yeah, that's right, Andy. Great to hear from you, and happy Thursday.
Thank you.
Yeah, GoEasy continues to have a rough go of things. Those shares fell by over 7% at their lowest point today, which is further eroding from the double-digit drop that we saw yesterday. And that's because the subprime lender reported earnings earlier this week, where they reported a loss of $8.93 per share just in the fourth quarter. So to put that into perspective, a year earlier, they actually had earnings of $4.45 a share. Management also mentioned that they're expecting elevated write-offs or write-offs to remain elevated for a little bit for a while before they improve later in the year. And to be fair, a lot of this has already been telegraphed weeks ago when management explained that they're expecting to see higher charge-off rates and impairments on their balance sheet, most of that coming from their vehicle financing business, LendCare. So a few new details that they mentioned this time around was the fact that they've cut 9% of their staff in the LendCare business to save money and recorded a goodwill impairment of about $160 million from LendCare, once again being kind of the culprit here. So CEO Patrick Enns took this opportunity in the conference call to explain to analysts how they essentially plan to right the ship here, and said that, like pointing to the multi-stage business plan that they've unveiled a few weeks ago, and said, hey, look, we acknowledge that we've got a lot of work to do here, but we're committed to building back stronger than ever. So we'll have to see how they plan to navigate that, Andy.
And Aya Gold and Silver produce silver in Morocco. We actually just talked to them the other day on commodities. What's the news there?
Yeah, so it's more of like an industry-wide story here. Aya Gold and Silver fell by nearly 10% at its lowest point today, and to be fair, it did end up reversing a lot of those losses. But that steepest drop was its biggest sell-off in about 2 weeks, and it's falling in tandem with other gold and silver names, as we saw from U.S. President Donald Trump's address to the nation last night that didn't really provide more clarity or new details on the timeline of the conflict in the Middle East and when it would come to an end. So spot gold prices were down by over 4% earlier in the session, which broke that 4-day winning streak back when traders were getting more encouraging signs that Iran and the U.S. were reaching some kind of a peace deal. But we heard from Trump last night, mentioned that the U.S.-Israeli alliance would continue further attacks over the next 2 to 3 weeks and would strike at electricity-producing plants. So that kind of counters some of the peace deal headlines that we saw earlier this week. So it's not just Aya that I'm picking on here. There's other TSX-listed names like Nova Gold and Abra Silver that were under a little bit of pressure earlier in the session, Andy.
Stephanie, thank you very much indeed. That's Stephanie Hughes of Bloomberg. Have a great weekend, Stephanie. Coming up, should you be investing right now in crude oil, or is the money already made? Well, we'll be right back. Volatile times. There's a temptation to jump aboard oil stocks right now. Of course, those future prices for crude, much lower than what people are actually paying in many cases in the real world. Let's get more from Brooke Thackeray, research analyst at Global X. Brooke, thanks very much. It's a very hard call, but is this a time to be buying energy stocks?
I still think there's more to go because the ramifications of what's going on is not going to be solved. There's always a lag, and everybody always forgets there's a lag. And we see knee-jerk reactions in the market, and we've seen that over the last month with the S&P 500. Every time that the White House comes out and says, hey, the war's almost over, the stock market rallies, and a few days later, everybody figures it out that it's not, and down it goes. And then we do it all over again, and then again. And so we saw in March this sawtooth pattern happening for the S&P 500. And, but we're forgetting that everything's got this lag. And even if we were to solve this situation right now and say, okay, magically the Strait of Hormuz opens up, it's going to take so long to get everything turned on. The tankers left on February 27th or 28th are just arriving at their destinations. We've got no tankers going into the Strait of Hormuz or leaving from the Strait of Hormuz. A few here or there, but so there's this huge lag going on. So I think yes, we might see an instant reaction if everything was settled, if that were the case, but there's no real signs that that's the case. But longer term, I still think we're in a tough situation for oil and energy, and I think that it has more to go at this point.
You say that we're just on the broad equity market, Brooke, we're seeing something of a sawtooth pattern. Is that because of what some feel are head fakes by U.S. President Donald Trump? He gets aggressive, then he's talking about ending the war, and then he flips back.
Yeah, that's exactly what's happening. And investors, it's a natural reaction. Everybody says, "Hey, we want peace. We want this to be end. We want it all over," and everybody jumps on board, and then it comes back down. But the keynote here, though, is that the overall trend is still lower for the S&P 500, even in the sawtooth pattern here. So there's still caution, and I do think if we did see some sort of deal happen, I'm not optimistic at all about that, but if it were to happen, the market might rally for a few days on that. But I don't think this is a done deal. And the fact that his latest big statement, because he made a public announcement about this, is it's going to take 2 to 3 weeks, and wars don't end on time. So and it needs more than one party to say it's ending as well. So it could be longer than that. And we've heard it's a few days. It's only take a week or two. So we still could have some more to go. Right now, the trend is still down. We're seeing some counter rallies here along the way.
Yeah, there was a famous German general Helmut von Moltke, the elder, who said no plan survives contact with the enemy. You just never know what way a war is going to go.
No, and Winston Churchill also has a famous quote around that basically, it's easy to start, but, you just, once you start it, it's out of your control as well. And that's exactly what we're seeing here. I don't think things are going as well as expected, if we can say that. So can energy still go up? Yes, and if we do see some more announcements being made that, hey, there's more backroom deals, if they are happening, or we're almost at a peace situation or whatever, we just don't know what's going to happen. But I still think overall, even if things got better, that the energy sector still could do well.
Maybe we could pop up a 5-year chart for the TSX Utilities Index. There's a case to be made here, you think, to buy utilities. Of course, there is a risk interest rates have to go up, and that would be hard on them.
Yeah, absolutely. There's no question that it's interest rates sensitive, but investors are looking for a place to hide right now. And so you're seeing some of the defensives actually do quite well. They're not really impressed with technology. Technology has been on this downtrend since last October. Late October, it's just been moving down. We've seen some rallies along the way, but overall trend is lower. The consumer's not holding in. We saw that burst higher with some of the cyclical sectors, with industrials, materials, and that's faded. So I think right now, utilities is a reasonable place to be. And yes, there is interest rate risk on that longer term. And if interest rates move up fast, that would have an impairment on that. But I think right now we are seeing this as an attractive sector when the market stumbles, and on a seasonal basis, it can do well in this time period when the market's having a little trouble. We're seeing some volatility, and that's the exact environment we're in right now.
Thank you very much, Brooke. Always great hearing from you. Have a great weekend.
Thank you.
Brooke Thackeray, research analyst at Global X. Up next, at the height of the AI spending frenzy, Microsoft CFO started getting cold feet and made a controversial call to hit pause on some data center developments. More on that next. At the height of the AI spending frenzy, Microsoft's chief financial officer made a controversial call to pause some data center developments. She has now acknowledged that maybe she was too cautious. Let's bring in Bloomberg's Brodie Ford. Great story, Brodie. So this happened in 2024, and the CFO said, come on, we're going to cool our jets on some of these projects. So what happened? Just remind us.
So you got to remember that these software companies, for most of their life, they didn't own any hard assets. They owned code, they had people, they had leases for offices, and that was it. And the data center moment, the AI infrastructure moment, has meant that they're spending tens of billions of dollars per year. And toward the end of 24, CFO Amy Hood looked at the numbers and questioned, is this getting out of hand? Is there really going to be the payoff for all this spending? And ultimately, she hit the brakes. A lot of people around her try to convince her that, no, this demand is real. But, I mean, she was feeling the anxieties that we see the market feel almost every single day. Are these big data centers going to pay off? And this is a question that kind of whipsaws constantly. You're showing this chart of Microsoft stock going down. Part of this is the market getting worried about the payoff of all this spending.
It's interesting. Yeah, I mean, and everybody's a genius in hindsight. And Hood has acknowledged that maybe she was too cautious and that, in fact, demand was ahead of her most pessimistic fears.
That's right. And I mean, it's the big question in the economy right now. I think the consensus view right now, whether you go to Meta or Amazon, is that you're going to spend as much as you can to try to seize market share, right? I mean, currently Microsoft is being held back by a lack of data center capacity. If you're a customer of their Azure cloud service, you can't get all the services you may want, and you can see that in the numbers because their growth rates aren't what Wall Street is hoping. So right now we're in a moment where it seems like compute demand is insatiable and any amount you spend is going to pay off. I would bet in a year we might have the same conversation and, things might be looking a little different.
Apparently, she was a math-loving kid in rural Kentucky. I mean, she's not a technology person, she's a financial person, but obviously a super bright individual. So it did hurt them, but it's fascinating. I mean, Brody, there are fears. We talked to a guest this week. We're very tight for time, I'm sorry, but who said that perhaps some of these data centers won't be built for years because you just can't get the equipment and the contractors.
They're logistically very difficult to get up, and more than that, they're incredibly expensive. And that's another thing Amy Hood is known for within Microsoft, is that every division has to accept a lower budget, right? I mean, all this money has to come from somewhere unless you're going to accept complete margin degradation. And of course, as you said, someone coming from Goldman Sachs with a financial background, she is not going to accept that.
Yeah, and she's overseen massive acquisitions, of course, Activision, Blizzard, and GitHub, etc. Thank you very much indeed. Great story, Brody.
Thank you.
Brody Ford of Bloomberg. Up next, Blue Owl, the big private equity fund manager, is facing massive redemption requests. Investors seeking up to $5.4 billion. We'll have more after the break. Blue Owl is a U.S. company that manages gigantic private debt funds. Investors are worried about private debt, and they're seeking to pull more than $5 billion US from two of these private credit funds. We've seen Blue Owl stock dropping. Let's bring in Bloomberg reporter Brian Chapata for more. Brian, thanks very much indeed for joining us. So in a major fund, investors wanted to pull more than a fifth of their money out, and then a technology income fund, they asked to take out 40%.
Yeah, it was pretty incredible. We've seen a lot of redemptions from these various business development companies, as they're called, private credit funds. We've seen them exceed 5%. A lot of managers have capped it at 5%, but usually the redemptions were something like 7, 8, worst case 10, 11%. But this was 20, this was 40%. These were really massive withdrawal requests that a lot of investors just wanted out. And Blue Owl, like other funds, basically had to throw up the gates and say, you know, we told you that we could limit 5% withdrawals if we need to, and that's exactly what they did.
And the worry, I think, is in particular the software industry, because equities have plunged for many software companies. Is Blue Owl thought to be particularly exposed here?
Well, the technology fund definitely is. They basically cited that in their letter, that one of the reasons that this was hit particularly hard was because they did lend a lot to software, and they were particularly concentrated in that space. But their flagship fund also saw 20% withdrawals. And like other private credit funds, they do have a pretty large exposure to software. They're pretty much known for that. They actually invest a lot in AI, but also in software. So they're kind of exposed on both ends of the spectrum. And look, they've been a relative newcomer to this space. They only became Blue Owl just a few years ago. So when you compare them to the Blackstone, the Apollo, the KKRs of the world, who have been around for decades, they are a new player. They grew really fast, and now they're kind of seeing the tide turn a little bit. And
it's complicated, isn't it? Because they different funds, they're sold under different mandates to investors. And so have some questions been raised about the differing treatment of investors in the funds?
Yeah, you bring up a good point. I mean, Blue Owl specializes in some of these non-traded BDCs, as they're called. They're not on a stock exchange like some other private credit funds. So what you do see is you see these vehicles that people are just now starting to understand have these redemption limits in place. So you actually can't get all your money out necessarily when you need to, if a lot of other people want to as well. So there's a lot of education that I think a lot of investors are learning about, that even Blue Owl executives themselves have said maybe we didn't do as good of a job of telling people ahead of time that this was something that could happen to them.
There have been many learnings, as Borat used to say. Thank you very much indeed for joining us, Brian Chapata of Bloomberg. Let's get more on what's happening with Blue Owl. We're joined by Dan Rasmussen, founder and portfolio manager at Verdad Advisors. I'm not sure if you heard that report from our Bloomberg partner there, but
I did.
What is jumping out for you with this situation?
I think the thing that you have to understand, I think we're in the early stages of a credit crisis in private credit. Right now, we have not seen major defaults. So the flows are really anticipating defaults. And the problem here is that it's a slow motion bank run, right? As investors pull their money out, it gets harder to refinance, liquidity dries up. You start to see who are the levered holders of these private credit firms. They start to get in trouble. And then finally, you get defaults when the firms go to refinance and they can't because there's no borrowing capacity out there.
That's interesting. I guess with these things, it's fear itself is the problem. And you're saying the underlying companies, we haven't seen a whole bunch of them failing to meet their debt commitments.
Not yet. I mean, there are a fair number that are picking, right, doing payment in kind, and that's obviously a bad sign. But the real problem will come when they need to refinance, right? And there's certainly a wall of refinancing that's going to start probably in 2027, 2028. So we're not there yet, but the market pricing and the BDCs moves ahead of those defaults, and the flows move ahead of them. They're leading indicators, so they will come. But this private credit crisis is real, right? These withdrawals will generate reflexively their own, self-reinforcing downward spiral for the asset class.
And so BDCs are business development companies. Can you remind us what those entities are?
Yeah, they're essentially publicly traded private credit funds.
Okay, thanks. Yeah. Now, we hear a lot of talk about problems with credit at software companies. Private equity has poured money in. Is that one of the underlying problems at Blue Owl as well? Software companies, investors just looking askance at them as AI spreads?
Yeah, so the private equity boom of the 2010s was financed by private credit, right? They're two sides of the same coin. And private equity and private credit went very deep into software. It was thought that software was eating the world, that therefore you should invest a very large percentage of your funds into software in order to garner that excess return. And then during COVID, essentially that was supercharged. So rates were very low and software seemed like it really was eating the world, and everything was moving online. And so people paid crazy prices for software companies for 3 or 4 years and put crazy amounts of debt on. I think everyone knew it was crazy at the time, but they had to, when the music was playing, they had to dance. And now what we're seeing is the unwind of those bad vintages and those bad sets of deals, which were concentrated in the software sector. And now AI is hitting software, and so it's doubly bad. But yes, that's the apex of the problem. But there was a lot of bad loans done in other sectors too. But certainly tech was the biggest problem.
And we're looking, BlackRock is down, not as much as KKR or Ares Management.
Yep, those ones are more credit heavy. The more credit heavy they are right now, the worse they've sold off. But the private equity businesses are going to be in trouble too. I mean, they're not getting the headlines, but private equity is subordinated to private credit. So if the private credit's this bad, the equity's got to be worse.
Yeah, that's interesting. We kind of forget that, don't we? The bondholders get first dibs. It's interesting as well. We've seen this push in both the United States and Canada to get retail investors into private investments. It seems like an odd time to be doing that.
Well, it's an odd time if you're thinking from an investor perspective, but if you're thinking from someone who owns these assets perspective, you're saying, well, gee, let's sell them to retail. Let's get them off our books and into their books and bail us out. And so I'm really hoping it doesn't happen. I don't think these are suitable for retirement accounts. I don't think retirement accounts should be paying 4 to 5% a year in fees on any type of asset, and certainly not for private credit.
Wow, is that what you're looking at, 4 to 5% typically?
Yes.
Wow, that's quite a take. You'd need to be investing in some high yield debt to actually justify that. Leave us with a
essentially what they're doing is they're lending at quite high rates, and then they're back levering it. So it's maybe 1.5x back levered, And that leverage is often coming from regional banks. And so what we're sort of thinking here is wondering where the contagion is going to spread, right? Who's exposed to private credit that we don't right now know is exposed to private credit? I think the insurers are an obvious one, the life insurers, the annuity providers, and then how much of these, the regional banks provide in liquidity and financing to help with the back leverage. And then who else are sort of the holders of this stuff? Because they're going to be in a lot of pain because in a lot of cases they thought and underwrote this as investment grade credit, which it certainly isn't.
And some of these private equity and private debt players, they've been buying life insurers, haven't they, to get access to the annuity cash?
Exactly. They've been raiding the float. So they've thought, wow, if I controlled an insurer, I can invest all of that insurer's float into my own company at 4 to 5% fees. And wouldn't that be great? I'd have permanent capital at high fees. And, they truly believe these investments were good investments as well. So they thought, and it's going to help the annuities. But I think it's all unwinding. And the question is, how exposed are these different insurers and annuity providers and reinsurers? And we're going to find out.
Wow, that sounds like a mess. Yeah, leveraging insurance companies' balance sheets to pull this off. Dan, I hope you come back because it looks like this story is going to run and run. Really appreciate it.
I think we've got a few more years of bad headlines ahead.
Thank you, Dan. Dan Rasmussen, founder and portfolio manager at Verdad Advisors. Up next, we heard from the interim commissioner at the Competition Bureau of Canada. Stick with us. The Competition Bureau has released its 2026-27 annual plan, focusing on improving, quote, affordability and choice for Canadians. We got more from Jean Pratt, interim commissioner at the Bureau.
I think our focus for enforcement is going to be on essential goods and services that Canadians need every day. They're facing affordability challenges, so we want to make sure that we have vigorous competition to help address the affordability concerns in those essential goods and services like housing and food.
Okay, so we're talking about grocery chains, and we're talking about telecom, with cell phone plans, internet, along those lines.
Anything that is an essential good where Canadians are really facing some challenges, those are going to be the priority areas for us for enforcement.
Okay, and what kind of enforcement, are we talking about? What kind of measures, at least that now, that Canadians can speak to, something that they might understand that they're watching right now? What exactly are you looking at?
Well, I can give a couple of examples from the last couple of weeks. In our mergers work, we recently reached agreements with the owners of senior residents to make sure that those senior housing remains competitively priced, because we've got a lot of aging population. We've got people who are facing housing challenges, and we can't afford to see rental increases in that sector.
Sure. Yeah, that's a great one. Go ahead. No, go ahead with another one if you have another one.
We've also, we do have a lot of confidentiality around our investigative work, but we also have an ongoing investigation with respect to property controls in retail grocery. So, when companies are putting up barriers to others entering by putting restrictive covenants on places where new grocery could enter, that has been an ongoing investigation that we've had for a couple of years, and that remains a priority area for us as well. And another area that a lot of Canadians will know us for is the bread price fixing investigation and class action work. So that investigation continues to be a focus for us as well.
Another thing that Canadians will be, that are familiar with as well is hidden fees, right? And different costs that, that get rolled into, things that come to mind are airplane, flights, plane tickets. We talk about concert tickets as well, even sometimes ride sharing, all these different things where all of a sudden you see a price at the bottom of that. Talk about some of the concerns that the Competition Bureau has about those hidden fees in particular and how you are able to, again, identify them and then possibly crack down as well.
Well, it is a focus for us, drip pricing in particular. So consumers need to know that the price they see is an attainable price. So two of the cases that we have ongoing that people may be familiar with that are in litigation right now are against DoorDash and Canada's Wonderland. So we're taking action on those. There were new tools that were added to the Competition Act a couple of years ago through amendments, and those continue to be a focus for us. We are also consistently looking at any deceptive marketing that could impact informed consumer choice on essential goods and services. So that will remain a focus for us going forward as well.
Yeah, and I believe the auto industry, right, has been part of that and subject to that, I think, in the past, at least for now. I want to ask you, too, as well, the difference in educating consumers and businesses, the difference as well between made in Canada and a product of Canada. Tell us about that, because that one also stands out to us.
Yeah, so we do have published guidance for businesses and consumers about what product of Canada means and what made in Canada means. There are additional labeling requirements that relate to food that are not within the Competition Bureau's jurisdiction, but we're really looking at when you make claims of made in Canada or product of Canada, that they are true products of Canada when it's an agricultural product, and made in Canada, there are specific rules around how you can use that representation, which means that, a good part of the transformation of the product has to happen here in Canada.
Which is certainly interesting, too, as well. We also talk about relationships as well, at least for the Competition Bureau, the difference and deepening between international and domestic. And how is that, again, for Canadians, how does that play a role in helping competition in this country? That's, again, I'm assuming across all sectors.
We operate in an era of globalized trade, a globalized business, and so international businesses doing business in Canada are just as much a focus of our work, and we have ongoing cooperation with our foreign counterparts as well, so that we can work together to combat issues facing consumers internationally as well as domestically.
Yeah, okay. Give me a sense, just before I let you go, Jean, too, as well, just generally where competition stands in Canada. I touched on it off the top. Do you believe that we have enough of it? And then we talk about, at least for now, there doesn't necessarily seem to be a lot of choice in some certain industries in particular. But where do you stand on where we are right now as a country when it comes to competition?
We need more competition. There's no doubt about it. We need it urgently. I think, the senior governor of the Bank of Canada has indicated that competition is an urgent need. We need more than ever to unlock the power of competition in our domestic economy, given the headwinds that we're facing internationally that Canadian businesses and consumers are facing. So, yeah, I unapologetically would say Canada needs more competition, and we need to work with partners at all levels of government to try to unlock more competition in our domestic economy.
So the Bureau went after Canada's Wonderland, which operates a huge amusement park north of Toronto. It's owned by Six Flags of the US, for fees that can run as high as $9.99, a processing fee for online purchases. Remember that Cineplex got slapped down over that one. That was Jean Pratt, Interim Commissioner of the Competition Bureau. Up next, Canadian brewers say the tax system needs a reset. The federal government is choosing to extend the cap on yearly increases in alcohol excise taxes for the next 2 years. The plan is to help craft brewers and distillers. We were joined by Richard Alexander, president of Beer Canada.
So back in 2016, the Trudeau Liberals decided that they weren't going to put this tax increase to the House of Commons, which is what most people expect happens when there's a tax increase. And since that went in, it was an automatic increase based on inflation. Since that's gone in, we've seen an 18% increase in the tax on beer and other forms of alcohol. And government yesterday just announced that they're going to do another 2% increase this year. And then the following year, they're going to do another 2% increase. So a 20% overall continuing to increase the tax on the product. And we believe that that's not in the best interest of Canadians right now. We still have an affordability crisis. The industry is struggling. We've seen an 18% decline in beer sales in Canada over that same period. And we've been asking the government, say, listen, we're not opposed to taxes. Just open up the House of Commons and have a debate about it so we can consider everything that's happening in the economy.
Yeah, and again, because there are lots of different factors, right, over the last little bit. And I know initially the tax was tied to inflation, and the cap is, how the government is trying to position this is the fact that this is why it's going to be more affordable. But you just touched on it, too, that there are so many different factors in particular that are affecting beer sales, restaurants, and otherwise, too, right now.
Yeah, so government is saying that this is they're capping the tax, but inflation is about 2%. So even without the cap this year, it would have gone up 2%. So it's hard for Canadians to accept that a $14 million increase in taxes on beer in 1 year is helping them with affordability. Or helping our industry survive the Trump tariffs. We've seen breweries. One brewery I've spoken with have seen aluminum costs increase 60% because of those tariffs. And our unions got together. All the unions in the brewing industry got together, sent an open letter, published an open letter to the Prime Minister, saying, "Look, jobs are at risk. You've gone too far with this tax. Volumes are down, and these are good-paying jobs right across the country."
So you talked about the tariffs, too. What are some of the other challenges, too, as well? As you talked about, the unions, at least at this point, too, and some of the job losses that could be there. I'm assuming, too, we've seen numbers in alcohol consumption have dropped significantly as well in the last couple of years.
Yeah, the big driver is what everybody is experiencing. All the viewers will know that the price of everything has gone up. It's a cost of living crisis in Canada. It still remains. The cost of everything is making people make choices that have been different in the past. So those choices are generally that they're going out less to restaurants. We sell a lot of our product in restaurants. That's hurting the mom and pop restaurants. It's hurting the brewing industry. And it's also hurting farmers. So about 90% of beer that's sold in Canada is grain to glass. It's produced here in Canada. We are a Canadian industry. And at a time when we're under threat by the U.S. and by Donald Trump in particular, it doesn't make sense for the federal government to be increasing taxes on a true Canadian product that Canadians love.
And have you gotten any feedback from the government yet, at least at this point? So, they've stuck to the cap, it sounds like, for the last couple of years. But has there been any, at least any softening in any position, at least for now, that they could and might increase, repealing the tax entirely?
Well, we've been talking about this for a number of years, and this year we've been going around with a coalition that we've built with the unions, with the grain growers, with other business associations, and it's clear that we have broad-based support across all political parties, all MPs in Ottawa. So the Liberal MPs have been helping us on this. Conservatives are all over at the Bloc, the NDP. But this was a decision that was made, I guess, in the Department of Finance and the PMO, and they seem to be willing to continue to increase taxes when sales of our product have dropped 18%. So it's very hard for us to understand the logic behind that. And it's very hard for individual MPs who are trying their best, and I thank them for all their effort around this.
And at least for you, for now, it would make a difference clearly, but do you need to see anything else beyond dropping the tax in order to help some of the suppliers, to help otherwise in the industry at this point?
Well, there are things that our government can control, and there are things that they can't control. Mm-hmm. So Donald Trump deciding to keep that 25% tariff on aluminum is hurting this industry. But they're doing their best to try and get rid of that, and we'll see what happens in the future. But we're still dealing with that massive cost increase. But what they can control is the taxation rates. So why would you increase tax on an industry that's dealing with a Trump tariff on aluminum, where the unions are concerned about their jobs, we're concerned about our employees, mm-hmm. and restaurants and bars are suffering. It's something within their control. They're not taking in any more money because the volumes have dropped.
Right.
So it's like we're beyond the point of maximum return on this tax. And it's just open it up to the House and let's have a debate with all MPs and see where that lands.
On Hot Picks, we zeroed in on 3 consumer discretionary stocks with Jamie Katz of Morningstar. We kicked things off with her first pick, RH.
I think the biggest problem is that, we're still looking at a pretty heavy investment year, and that has led to a lot of investor concern about profitability and when maybe profit margins can continue to, or return to expansion rather than compression. So we do think there's a little bit of time before these shares get moving. But I think when you look at where the shares are trading now, we really haven't seen levels like this since the beginning of the pandemic, where there was a lot of uncertainty. And I think, there are going to be some costs that roll off next year that are going to allow 2027 to be an operating margin expansion year again.
Yeah, and I mean, this is very different, I guess, from 2020. Do you think what gives you the optimism it'll bounce back?
Well, I think, we've already been made aware that there's probably roughly 300 basis points of costs in this international operating expansion strategy. And those costs are largely coming off next year. So we know that there are going to be some changes to the cost structure that will make it a little bit easier to digest the operating efficiency of the business. And again, I don't think we're looking at a business that's going to grow 20% a year, but they are investing in innovation. They are launching this RH Estates business. It is very traditional. There are a lot of homes that are exposed to that sort of styling in their house. And so I think that gives them an opportunity to continue to grow faster than the market.
All right. Next up, Norwegian Cruise Lines.
Yeah, this is a great turnaround story. It's a business that has really lagged its peer group, relative to Royal and Carnival. They did have a recent activist investor take a stake, and so they've refreshed their board, 5 new members. There's a new CEO at the helm now, and I think there were some sort of self-inflicted decisions that were made that will roll through the P&L and get the business back on track. But basically thinking about how deployment looks going forward, how demand looks, consumers are still cruising, and the appetite for value focused vacations is still pretty high given economic sensitivity.
And what do you like about having the activist investor in there?
I think it just facilitates change at a little bit of a faster pace. And so, again, maybe we wouldn't have had 5 new board members if somebody wasn't out there sort of, shaking the trees over that. But it puts a fresh set of eyes on the business and maybe brings some fresh insight to how the business can sort of accelerate to its next level.
And the new CEO?
The new CEO comes with great operating experience, so I think it will be interesting to see if he makes significant changes outside of just sort of the deployment strategies that they are reconsidering. He was on the board for many years, so I think he's got a good handle on sort of the underlying puts and takes of the business.
Okay, and moving on now to BBWI, Bed Bath and Beyond, right?
No, close, but Bath and Body Works.
Bed Bath and Body Works.
That's a mistake that everybody makes.
So close.
And
I shop there regularly, as you can tell.
also a turnaround story. The men's business is doing okay for them. So, maybe it's something you should check out. But I think they have a new CEO who came in from Nike last year as well. And they're making some changes to their business, refocusing on their core competencies, exiting lines that really aren't accretive to them, and really trying to figure out how they can be more productive. So still expanding in the off-mall channel, which tends to be a more productive store base, launching their Amazon store, which is something that they didn't have before, and really just trying to meet consumers where their needs are. And so I think there's a lot of opportunity for margin expansion in this business because I think the firm got a little bit distracted as to sort of what its best ROI opportunities were. And now it is sort of re-honing in on that, which should allow profitability to reaccelerate.
And is Amazon a place you feel this company could thrive?
Well, so, there were third-party sellers out there selling their products, right? And it was moving, but now they can control the messaging. And for people who are impatient and they want, to get everything in one place and not go to a store or not go to a separate website, I think it gives them an opportunity to just reach consumers at another touch point. So even if it's $100 million in revenues first year, it's another channel where they are penetrating and controlling the narrative.
Any concerns? If we see oil prices stay up where they are, put pressure on consumers, this might be one of the places where they cut back?
Well, I think this is actually affordable luxury. I think when we look at oil prices and what's happening in Iran, certainly the cruise lines are the companies that have been hit pretty heavily by this. So Norwegian may be something that's impacted. Consumers get worried about traveling towards the Mediterranean and, whether that can spread. And so I'd be more concerned about Norwegian than I would be about Bath & Body Works.
Jamie Katz, senior equity analyst at Morningstar, joined us earlier. Thank you very much indeed for watching The Close. Have a wonderful Easter weekend, everybody, and we'll be back on Monday.